Want to invest in stocks that could supercharge your portfolio for the next decade? Today, we're diving into two explosive growth stocks that could dominate their industries in 2025 and beyond. Trust me, you'll want to stick around for this one. Hi. In today's video, we're going to explore two development stocks to buy in 2025 and hold for the next 10 years. These aren't just stocks. They're powerhouses set to ride transformative trends in e-commerce, cloud computing, and AI. Thank you for watching, and please subscribe to my channel, The Finance Savvy, for more updates and insights. Got questions? Feel free to reach out. Now, let's dive into the video. Part 1. Shopify, the e-commerce giant redefining retail. First up, let's talk about Shopify, NYSE Shop, the kingpin of e-commerce solutions. Now, think about this. E-commerce currently makes up just 16.2% of all U.S. retail transactions. That's a massive growth opportunity. And Shopify? It's at the very heart of this transformation. If you've ever bought something from a small business online, chances are it was powered by Shopify. But Shopify isn't just about helping merchants set up online stores. It's much more. They offer tools for payment processing, inventory management, marketing, and even social media integration. Plus, their app store allows merchants to customize their operations with thousands of tailored applications. It's like having a business Swiss Army knife at your fingertips. Let's talk numbers. Shopify saw its revenue soar by 26% year over year in Q3 2024, hitting $2.2 billion. Free cash flow? Up a staggering 52.5%, totaling $421 million. That's not just growth. That's momentum. Shopify's platform benefits from what's called switching costs. Once merchants start using Shopify, moving to a competitor is tough. It's sticky, and that gives Shopify a significant competitive moat. Combine that with its long runway for growth, and it's clear Shopify is a strong contender for investors looking to ride the e-commerce wave for the next 10 years. Part 2. Veeva Systems, the cloud specialist for life sciences. Next, we have Veeva Systems, NYSE, VV, a company revolutionizing how life sciences organizations operate. Here's the deal. Life sciences companies face enormous challenges, regulatory hurdles, sky-high R&D costs, and constant pressure to innovate. Veeva Systems steps in as the cloud computing superhero for this industry, offering tailored solutions that help companies navigate these challenges efficiently. Unlike generic cloud providers like AWS or Microsoft Azure, Veeva specializes in life sciences. Think of it like this. Hiring Veeva is like hiring a specialist electrician for a complicated job, rather than a general handyman. Veeva offers highly customized solutions, which is why it counts some of the biggest names in the industry among its clients. Financially, Veeva is rock solid. It generates consistent revenue growth, and it benefits from high switching costs. Once a life sciences company integrates Veeva's software into its operations, switching providers is not just inconvenient, it's risky. In a regulated industry, that's a deal breaker. And the growth potential? Veeva estimates its total addressable market is $20 billion, and that's a conservative estimate. With trailing revenue of $2.7 billion, they've barely scratched the surface. Imagine what happens when Veeva captures 30% or more of its market over the next decade. Personal connection and analysis. Now, let me give you my 2 cents here. These two companies are not just riding trends. They're shaping the future of their respective industries. Shopify is revolutionizing retail with its scalable and innovative tools, while Veeva is cementing itself as a critical partner for life sciences companies navigating a high-stakes industry. And let's not forget, both companies have built-in moats. For Shopify, it's their vast ecosystem and the cost for merchants to switch. For Veeva, it's the regulatory challenges of moving to another provider. These moats make them highly resilient, even in uncertain economic times. So, whether you're excited about the continued rise of e-commerce or intrigued by the massive potential of life sciences in the cloud, Shopify and Veeva Systems are two stocks you should definitely keep on your radar for 2025 and beyond. Can a stock that's been cratering make a historic comeback? and even outperform one of the most hyped companies of the year? Today, we're tackling the case of Uber versus Palantir. It's a battle of innovation, valuation, and long-term potential that could redefine the 2025 investment landscape. Hi! In today's video, we're going to explore why Uber, despite recent struggles, might not only bounce back, but potentially become a better investment than Palantir by the end of 2025. Thank you for watching, and please subscribe to my channel, The Finance Savvy, for more updates and insights on how to navigate today's stock market. Got questions? Feel free to reach out. Now, let's dive into the video. Previously, or a few seconds ago, we explored two long-term growth stocks, Shopify and Veeva Systems, that are poised to dominate their industries. But not every great investment starts at the top. Today, we're shifting gears to a stock that's had its ups and downs, Uber. Can this ride-hailing giant overcome its current challenges and leave one of AI's biggest players, Palantir, in the dust? Let's break it down. Part 1. What's happening with Uber stock? Let's start with the big question. Why is Uber underperforming? While Uber managed a modest 9% gain over the past year, it lagged behind the broader S&P 500 and Nasdaq composite. The stock saw a roller coaster year, initially declining by 7%, but rebounding to gain 37% by October. Then came December, and things took a turn for the worse. The culprit? Concerns over autonomous vehicle fleets. Specifically, Alphabet's Waymo partnered with a startup called Move to manage its robotaxi fleets. For investors, this was unsettling. After all, Uber is the dominant player in ride-hailing. Why wasn't Waymo working with Uber? This announcement sent shockwaves through the market, triggering a sell-off as fears grew that robotaxi competitors like Waymo and Tesla could disrupt Uber's dominance in mobility. Part 2. Why these concerns might be overblown. But hold on, before we hit the panic button, let's take a closer look. First, Uber isn't just a ride-hailing company anymore. It's diversified. Its delivery business, including food, alcohol, and even convenience store items, through platforms like Draisly and Postmates has grown significantly. In fact, Uber Eats is a market leader in many regions. Second, let's not forget Uber's global reach. It operates in over 70 countries. While autonomous vehicles might disrupt mobility in select cities, it's going to take a long time, likely decades, for full-scale adoption across all these markets. Finally, there's the potential for collaboration. Autonomous vehicle fleets won't replace Uber overnight. In fact, partnerships between Uber and players like Waymo or Tesla could emerge. Imagine a world where Uber acts as the distribution network for robot access, ensuring it maintains relevance in the evolving mobility landscape. Part 3. Why Uber could outperform Palantir in 2025. Now, let's get into the bold prediction. Why Uber might be worth more than Palantir, PLTR, by the end of 2025. Here's the math. As of now, Palantir has a market cap of $160 billion and trades at sky-high valuations. Price to sales, PS 62. Price to earnings, PE 341. Meanwhile, Uber is trading at much more reasonable multiples. PS 3.4. PE 33. Despite concerns, Uber's fundamentals haven't changed. The company is still positioned for long-term growth, and its valuation leaves significant room for upside. On the flip side, Palantir has been riding high on AI hype. While it's a clear leader in artificial intelligence and big data, these lofty valuations may not be sustainable. If investor expectations for Palantir normalize, or if it experiences even a slight pullback, Uber could emerge as the more valuable stock by comparison. Part 4. What needs to happen for Uber's comeback? For Uber to rebound, a few things need to fall into place. 1. Stabilize market sentiment. Once investors see that autonomous vehicle fleets are not an immediate threat, confidence could return. 2. Leverage partnerships. Collaborating with companies like Waymo or Tesla could ensure Uber remains integral to the future of mobility. 3. Expand delivery and international markets. Uber's diversification and global reach could drive new revenue streams. Personal connection and final analysis. Here's my take. Uber is a classic underdog story. Sure, it's been knocked down, but the company's fundamentals are strong, and its long-term potential remains intact. On the other hand, Palantir's sky-high valuation makes it vulnerable to a pullback. If you're an investor looking for a rebound play with a solid foundation, Uber might just be your ticket. Again, thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe to the Finance Savvy for more insights on navigating the stock market. Got questions? Drop them in the comments. I'd be happy to help. See you next time.